Welcome, everyone. My name is Jim Schowalter, Commissioner of Minnesota Management and Budget. With me is Dr. Tom Stinson, State Economist, and Margaret Kelly, State Budget Director. We're here to present the November 2012 forecast. There is no relief in sight for our fiscal woes. Our projections show that the state still has some heavy lifting to do just to get the budget into balance. This forecast anticipates a $1.1 billion deficit in the next biennium, the same amount as projected at the end of the last legislative session. This deficit is the direct result of a continuing mismatch between state revenues and ongoing spending commitments. The state's forecast does anticipate new balances this year, which will be used to pay down some of the K-12 payment shifts based on current law. We will restore about $1.3 billion of those payment shifts, leaving about $1.1 billion still to be addressed. This forecast is not without risk. Most notably, despite all the skill and experience of our economists, forecasting congressional action remains beyond our reach. The federal fiscal cliff is real, it's large, and it's unresolved. As a result, state revenues could easily swing from the projections we're going to be discussing today. If you look at the first graph following that summary sheet, you'll see some of the explanation of the $1.3 billion improvement in the current budget biennium. Much of that information was already known as fiscal 12 improved our balances and ran ahead of expectations and revenues, and the last couple of month revenues have also been improvements. Beyond that, spending has been slightly less than expected, and some notable one-time adjustments have also improved the balances that total up to the $1.3 billion. Because of statutory law, we will be taking that $1.3 billion and using it to reduce the aid payment shift from previous legislative sessions. As a result, the payments going to schools will move from 64.3% and 35.7% as a settle-up to 82.5%, 17.5% as a settle-up. We still have some work to do here. There's about $1.1 billion in shifts that remain. That includes both aid payment and property tax recognition shifts. The outlook for 2014 and 15 is largely unchanged, and a key consideration here is that the improvement that we've seen in the current year doesn't carry on into the next biennium. As you'll see here, forecast revenues are actually down slightly, offset by a few other moving elements, including some slightly lower spending numbers and other adjustments. In the end, the $1.1 billion challenge that we knew that we had at the end of the last legislative session remains and continues to define the budget challenge for the governor and the legislature in this upcoming legislative session. We've had three successive positive forecasts in the last few years, or last year. But really, the structural imbalance is the underlying story. That despite those changes, we see that $1.1 billion remains the challenge going ahead. With that, I'm going to turn it over to Margaret Kelly, State Budget Director, and she's going to focus in on some of the specifics in the spending estimates that we have.
Thank you. I'm going to speak to the spending estimates. So state expenditures have changed very little between the estimates from the end of the special session to this forecast. $262 million in the current biennium and $100 million in the next biennium. You can clearly see from this chart, if you can read that, it's primarily in the Health and Human Services area, but I'm first going to run through some of the other areas. In K-12, enrollment growth has been slightly lowered in this forecast by just about 0.25%. This is the primary reason for spending going down in both biennia. It is offset by some increases in other aids in the out biennia. But overall, we continue to see enrollment growth of about 3.2% as we look across the 4 years. Property tax aids and credits are down in both biennia, and It's primarily that we are spending less on homeowner refunds, offset a little bit by renter refunds, reflecting a trend in the market that the property taxes are shifting away from homesteads and that there is a shift away from home ownership given the housing crash. Debt service is also forecasted to be down in the current biennium, slightly in the next biennium. Favorable interest rates in our most recent bond sale reduced our debt service costs, as well as a smaller size of our bond sale based on the cash flow needs of agencies. All other spending, you can see in the out biennium, a $139 million increase. This is more than we typically see in this category of spending, and it is driven by the recent tobacco bond refunding of just earlier this month, I believe. So we had moved we had done a tobacco securitization bond sale a year ago, and that was using our tobacco revenue stream to pay for the debt service on that, all outside of the general fund. With the refunding and using appropriation bonds, we are now capturing the revenue and the spending within the general fund. So what you see here is the debt service on the tobacco appropriation bonds that previously had been outside of the general fund. Going back to Health and Human Services, $196 million savings in the current biennium, $185 million in the out biennium. This is less than a 2% change in overall spending, and it is primarily driven by a medical assistance program. So there are three key drivers in our healthcare spending: enrollment, utilization, and cost of care, and we are seeing all of those changes coming into play in this forecast. And I encourage you to go and read our document online that talks about all the different changes that are happening within the various components of our medical assistance program. There are lots of changes going on in this forecast, but I can sum them up in a few easy points. One is the average cost of care in several of our larger programs is lower than we had expected. There's lower utilization going on, and so there's lower average cost of care. There are lower caseloads in other large programs of our medical assistance programs, specifically in elderly basic care and our long-term care facility programs. And so that lower enrollment compared to previous forecasts for enrollment is is providing some savings. And also pharmacy rebates. In the Affordable Care Act, the state is now eligible to receive pharmacy rebates on our managed care side of our business, in addition to our fee-for-service side of the business. You've heard me talk about this in previous forecasts, savings resulting from this, and we continue to see additional savings from the pharmacy rebates. 40% of the $185 million is coming from additional pharmacy rebates. So overall, because we are seeing a $1.3 billion savings in the current biennium, we will use that to buy down our K-12 shift debt. And so we will increase our spending in the current biennium by $1.324 million. So spending, while underlying in the forecast is going down compared to previous forecasts, by buying back the shift, we will actually be increasing our spending in the current biennium and increasing it by an additional $57 million in the out biennium. And before we move on, I just want to speak a little bit to the risk that we have on the expenditure side of the forecast. We have a lot more uncertainty in this forecast than we typically do. It's attributable to the Supreme Court decision around the Affordable Care Act. And so the Affordable Care Act required states to expand their Medicaid programs to cover adults without children up to 133% of the federal poverty guideline. In state law, we have expanded our program to 75% of the federal poverty guideline. We are assuming we'll receive the 100% match on that expansion, but CMS, the Centers for Medicare and Medicaid Services, have yet to provide guidance to states on how they will interpret the Supreme Court ruling. So it could be that we receive 100% match. It could be that we receive no match on that expansion. And so we have in this forecast assumed $4.3 billion of federal financial participation in our Medicaid program associated with that program element. And that is the amount that is at risk based on CMS interpretation of the law and decisions by the legislature in terms of how to expand eligibility for that program. And I will turn it over to Dr. Stinson.
Well, the revenue story is a pretty simple one, but it has an interesting complication. The simple part is that revenues for 2012-2013 are up by $1.076 billion, about 3.2%. And as the Commissioner indicated, the revenues are the source of most of the change in the forecast for the current biennium. The big three revenues, the individual income tax, the corporate income tax, and the sales tax, are up $709 million, or about 2.6%. The income and the sales tax are up by around 1.5%. The corporate is up by 18%, reflecting strong corporate profits over the biennium. Overall, and it's important to know, about half of the additional revenue that we are expecting is already in the bank. So part of what's going on here is a higher base. For 2014 and 15, the news is not quite as good. The forecast is slightly less than the end of session planning estimates. The 2014-15 forecast is $68 million, or about 0.2% less than previously projected. Now, normally you'd say that's pretty good, being within 0.2%. But if you look at the numbers, what you see is that we've benefited from Saint Offset, the patron saint of forecasters. We have a big $548 million decline in the individual income tax that's then set off by the positive numbers, offset by the positive numbers for the sales tax and the corporate tax and other revenues. The weakness in the individual income tax comes from about half of it is due to a weaker economic outlook, primarily a weaker outlook for wages. If you go to the next chart, you can see, if you look at the bars, that the darker colored bar, which is the current forecast for the growth rate, is less than the growth rate expected for 2014-2015 in February. It's not a lot less. We're not seeing a big decline, but it's about 0.5% less both in 2013 and in 2014. The slower economy means slower wage growth, slower employment, and means less individual income tax. That explains about half of the change. The other half of the change comes from capital gains. It's not that we're expecting a weaker stock market or anything like that, but we are expecting some acceleration of realizations, capital gains realizations, into 2012 as high-income individuals seek to avoid the 3.8% increase in taxes that begins on January 1 to help pay for the Affordable Care Act. That behavior, that investor behavior, selling stocks that have gains in it in December rather than January to minimize taxes, that shifts 150 to 200 million into 2012. Now, you can't miss the dotted line in there. And by this time, you all know what it shows. What it shows is the fiscal cliff. What happens if the perfect storm of tax increases and expenditure cuts actually occurs? And forecasters are warning that it won't be pretty. Problems could still be averted. The President and Congress could still reach an agreement. But if they don't, there could be problems. Global Insight notes that the fiscal cliff and its resolution is both the biggest upside and the biggest downside risk to the forecast. The upside is that if the President and Congress were to do something fiscally responsible between now and the end of the year, markets would likely react and consumer confidence would continue to build. We would see maybe 0.5% or more stronger growth in 2013 than is currently in the forecast. But the downside impacts are so serious that we did something we haven't done before. We did an alternative forecast that incorporates Global Insight's Fiscal Cliff scenario into our Minnesota economic model and our Minnesota tax model. Matt Shepner and John Peliquin of my staff worked quite a bit on this because we think it's a very important addition to the forecast and demonstrates the risk that we see. What did we find? Well, going off the fiscal cliff produces a recession. The first quarter, as you could see in that other graph, GDP falls by 3.6% at an annual rate, and the second quarter by 0.8% in there. For Minnesota, we end 2013 with 45,000 fewer jobs than is in the baseline forecast. That doesn't mean that employment shrinks from today's levels by 45,000 jobs. We have about 50,000 jobs in the forecast, and so that means instead of gaining 50,000 jobs over the next year, we would gain about 5,000 jobs. The same way, looking to 2014, we have about 100,000 jobs forecast cumulatively for growth between now and then. We would lose 70,000 of those, and so we would only have 30,000 jobs growth. The unemployment rate would increase. It would increase to 7.1%. It's now 5.8%. The U.S. unemployment rate would increase to 9% in this model. And personal income in the state, the most complete measure of state income, would fall by more than 4% from forecast by 2015. What does it mean for revenue? The slide up here shows you. On the income tax, it means that we would have a shortage. We would have at least $700 million less in individual income tax receipts in 14 and 15 due to the economy, and because the tax rates would go up on capital gains realizations and other income, you would see some shifting of income out of 2013 into 2012. Those behavioral changes would be substantial. We suspect that they could be as much as $400 million in taking out of 2014 and 2015. The sales tax falls by about $350 million. The corporate tax by at least $250 million. The big three taxes that we have, the sales tax, the income tax, and the corporate income tax, would fall by about $1.7 billion in 14-15 compared to our current baseline forecast. That's about 5% of state revenues. Now, this is not in the forecast, and it's important to recognize that we did this not as our baseline forecast, but to provide people with an idea of the risk involved, the downside risk involved with respect to the fiscal cliff. By February, we're going to know a lot more. The Congress and the President will have acted, or if they haven't acted, those tax rates will have gone up that are going to create a problem. If they fix the problem, fix it in a responsible manner, that's going to be good for the national economy and good for the state's economy, and we would have more revenue. If they kick the can down the road or allow us to go off the fiscal cliff, it probably costs us money. With that, let me turn it back over to Jim.
Okay. To wrap up the briefing, I wanted us to take a look and consider where we've been and where we're going to. The one-time budget actions really underlie the budget shortfall that we have looking at us in 2014-15. If you remember the 12 and 13 budget solution, we had significant revenue increases that were one-time in nature, like over $460 million of transfers from the Healthcare Access Fund over to the General Fund. On the other hand, the spending numbers were different and hard to track because of aid payment shifts, along with the securitization of tobacco revenues. And so the biennial picture is extraordinarily confusing this time. But one thing persists, and that is that one-time actions only happen one time. And when you're trying to get a structural balance together, we still have some work to do. In order to deal with those problems, we still have about a $1.1 billion challenge looking at us going into the future. Longer term, we do know that we always put together 5-year projections looking into the in this case, 2016 and 17 biennium. While we have significant concerns over even the next 6 months of economic activity and revenues, looking out 4 years is even a little bit more difficult at this point in time, but we want to provide that information, and it really does start to converge based upon current law estimates. Current law also, of course, doesn't include any effects of inflation, and so we provide that information as well. So if you include the effects of inflation, you'll see that there continues to be a gap between the revenues and spending, but both ways you've got that information. More importantly, I think to wrap up this briefing, is the question of the next couple of months. With the federal fiscal cliff, what happens in congressional action, and ultimately what happens in the economy. It's hard to understate how serious the recession has been on the state's budget, and we still have some work to do in order to get it back together, to get it back into balance, and to get it back into structural stability. The federal fiscal cliff creates some risk around that forecast, and in the next couple of months we should know a lot more. We'd be happy to take any questions that you might have on the briefing today.
Or if you would, about the effect of one-time money in the current budget and its effect going forward. Is it accurate to think that if we had backed up current spending with permanent revenues rather than one-time revenues, we would be out of deficit going forward in 14 and 15?
Yes. If you think back even to the initial estimates at the time of resolving the 12 and 13 budget, we had about a $1.8, $1.9 billion deficit. If we had been able to resolve it at that point, we are actually a little bit better off than we were even then.
Dr. Stinson, on your fiscal cliff comments, is it fair or accurate to say that if we go over the fiscal cliff, it would be a $2.8 billion deficit? Can you add the 1.1 and the 1.7?
Yes, I hadn't done the arithmetic until you do it, but if we were to go over the fiscal cliff, the February forecast, everything else staying the same, would be 1.7 worse for 14 and 15. There would be some improvement, further improvement in 2012, 2013, because some of that money would be shifted forward into 2012, 2013, but of course that wouldn't help offset the problem in 14, 15 because it would go to the school aid shift.
And when does that payment go to school aid? Is it after January 8th, so could the legislature make a change?
We begin paying back the schools with the December 15th payment. About half of it goes out the door December 15th, and the balance goes out in subsequent payments through the end of the fiscal year.
So they could make some change in January if they got on the ball and wanted to change it?
They always could, but as Margaret suggests, the payment shift will start to be repaid in just a couple weeks.
Commissioner, can you clarify whether there really is a surplus or not then in the current biennium?
We're not using the word surplus because we still have more than $1.1 billion of obligations that would be repaid before we could actually get to a surplus. We do have a balance that will allow us to start repaying $1.3 billion of obligations.
And looking forward, what is your counsel for the large crop of new lawmakers coming in facing their first budget?
Counsel for the new crop of lawmakers is that we still have some tough decisions and heavy lifting to do. The fiscal balance of the state isn't going to just happen naturally, and we've got some work to do in order to bring it together, both this biennium and bring stability into future biennium.
Why is it important to eliminate the structural deficit that we've been living with for most of the past decade?
There was a question about why to focus on the structural deficit. A couple things. One, it keeps the discipline of using permanent revenues and permanent spending and making sure you're not fooling yourself by using one-time tricks. The second thing that is important is it gives you a measure of sustainability going into the future that is important for the state and certainly something that the federal government is grappling with now as well.
Sure. What happens if Congress and the President go over the fiscal cliff, but then the situation is resolved in the days or weeks after that? Do these doomsday scenarios for the state budget go away then?
The fiscal cliff is characterized as a cliff. Some people say it's more like a slope. I think the bottom line is there's going to be impact as we get to January 1 and beyond that. There are some things that the federal government can do to mitigate the immediate economic impact. I think there's still behavioral and psychological impacts and economic risks that are there. Depending on what that deal looks like, when it's cut, and what everyone's reaction to will really shape the February forecast.
Could you talk a little bit more about the fiscal cliff scenario and the recession that would ensue and how long it would take to emerge from such a recession, what the economy would look like during that period?
The Global Insight forecast is that the recession would start January 1, or at least it would start in the first quarter, and that would be the most severe quarter. That would be the economy would decline at a 3.6% annual rate during that quarter. The second quarter would decline at an 0.8% annual rate. The third quarter would be roughly flat. And so it wouldn't be until this time next year that the economy would start to turn up again.
Presumably in a weak way as well, as the case now.
That would be a recession, obviously. And I can't remember the rest of your question.
Oh, so the total recession would last about a year? Is that what the projection is?
Probably somewhere 7 to 9 months.
Dr. Stinson, are there any bright spots in the Minnesota economy? Farm income was looking to be good, big purchases from that farm income. Is ag a positive sector?
This isn't a negative forecast. This isn't a gloomy forecast. The fiscal cliff is ultimate gloom, but this isn't a negative forecast. This is a forecast that shows the economy continuing to dig its way out of a recession, slowly improving. We think that by the time the revisions are taken into account, that Minnesota's employment will be growing a little faster than the national employment. All of these things are good. It's just that it's not the kind of quick recovery that we had hoped. And it's been it's been almost 4 years now that we've been in the recovery mode, and that's just that can't be right, can it? Yeah, 41 months.
And I'm sorry, and ag, is that showing up as a positive?
Agriculture is certainly a positive. It will be a positive for 2012. The question is, of course, what happens to the weather looking out for 2013. If we have good weather and there's sufficient moisture for crop yields to hold up, it will be a good year for 2013 as well. But overall, because so much of the sequestration is on the defense side, that's good for Minnesota. And Margaret or Jim can talk about this in more detail. If if part of the deal is to reduce Medicaid reimbursements to the state, that wouldn't be a good idea. Margaret, maybe you want to.
Sure. The sequestration is about $100 billion, and Minnesota, on average, gets about 2% of federal allocation. So you could see what the impact of that would be on Minnesota, and that's on grant programs, it doesn't necessarily impact the general fund. The biggest piece of that sequestration is on special education funding, so that would put pressure on school district budgets and local property taxes. But if sequestration was off the table and entitlements were put back on the table, then Minnesota's Medicaid program and the federal participation in that would be subject to reductions. Currently, Minnesota receives a 50% match, and one of the things that has been talked about is lowering that floor down below 50%. And so if our match rate were to drop from 50% down to 49%, we would lose about $240 million of federal participation in the next biennium. So,
Commissioner, as the governor starts to put together his budget proposal, this big question is looming out there. Are you counseling him to, or how are you counseling him to deal with that, I guess, is how I'll ask.
Sure. The budget process really has started, and with today, we'll be able to orient ourselves going forward as to what the challenge is. Our counsel has been pretty simple. Focus on programs that work. Make sure we get some more measurement into the performance metrics activities, look at the tax sustainability and tax reform issues, and then come out with a package that I think meets his values and expectations. The slide up and down of a forecast shouldn't be the test of the budget. It really is, the statement of priorities and how it fits.
To build on the statement of priorities, and a bit sort of build on Don's earlier question about, should you take some of the money destined to pay back the schools and maybe move that somewhere else? If there is more money in the, they do some budget adjustments to come up with more money, is the best thing to do to just pay off the rest of the school shift right away? Does that make the best sense for stabilizing the budget and improving the state's economy going forward?
The shift itself doesn't destabilize the state budget. And the shift itself doesn't destabilize schools. It's the changes from time to time, especially when money flows away from schools and they're not able to plan accordingly. I think over time, rating agencies look at the state and say, how are our obligations matching up with our assets? And they look at that and say, this is a multi-billion-dollar obligation of the state. It's in our interests to enhance our credit rating, I think to enhance our fiscal flexibility in the future to get them repaid. It's not an immediate, day one need. State statute basically gives us the course, which says when you've got some extra money in the current biennium, put it to this first.
Where are the budget reserves right now? How much?
Budget reserves are just a little bit under $1 billion. See there in this chart.
Stinson, you said a moment ago that we've been 4 years in recovery mode here. Based on your forecast and disregarding the fiscal cliff, how much longer before we really have reached new normal and we're out of recovery mode?
I can't remember. Your number would be, or the number you would say would be the employment level. And I can't remember, but it's 2015 or 2016. We still have a ways to go. I think it's 2015. That said, incomes are increasing. Personal income is increasing. And so on the income side, we're doing better. It's the job side that we're not doing as well.
Dr. Stinson, there have been several stories recently about the housing market improving. Do you see improvement there? And if so, how is that affecting our state economy?
The housing market is looking stronger. And if we don't go over the fiscal cliff, that's going to be what leads the state economy looking out into 2013 and 2014. And it's really good that area of the economy is picking up, because that's the area that was hurt the most in terms of employment. The skilled trades workers in construction are the people that suffered the most in the recession, so that if we start to turn up in housing, and we think we will start to turn up in 2013 and then get back closer, much closer to normal in 2014, that will provide jobs for people that have had a really difficult time looking out over the last 4 or 5 years.
Dr. Stinson, what's current state's debt capacity?
I don't know.
Got it. With this forecast, there's other documents that are released and are available on our website. One is the debt capacity calculations. The 3.25% limit is the binding one here, and it's about $1.3 billion.
Does this forecast include any bonding?
This forecast soon makes the usual assumptions on a 10-year rolling average. 225 in this forecast, in this year.
Commissioner, you've got a governor who's got a little more influence over the legislature now than he used to have. Will you be recommending a reversal of that policy of 10 years ago of not counting inflation in these forecasts on the spending side?
Obviously, the governor is going to come to his conclusions. The legislature is going to come to their conclusions. It's been a long-standing recommendation from the Council of Economic Advisors, from the department generally, that inflation is something that needs to be considered when looking at long-term obligations and structural stability.
Ms. Kelly, I'm just curious, what are our annual principal and interest payments on the tobacco bonds?
We are assuming in this forecast 133 million of the 113 million of the 139 million increase is driven by the debt service on the appropriation bonds. I think that's the annual number, 113. We'll double check that. But.
So without concerning Fiscal Cliff, is this a good forecast?
I'll repeat what Dr. Stinson said. I think we are making slow progress, gaining jobs and economic momentum. The trouble is it's wrapped in the cloud of fiscal uncertainty due to the federal fiscal cliff. We'll know a lot more if it's good news in a few months. I do have one piece of good news, though. If you're looking for just flat-out good news, it's our favorite topic, SWIFT. Buried inside the fabulous 102-page document that you all have, which gives you lots of details, lots of things for future things to consider about stories and considerations about the state economy, things that are going on in the state. One of them is that the new accounting and procurement system and the new budget and the new processes, business processes that went with it, led to detecting an underpayment or under-recapturing federal participation in the MA program, yielding about $139 million. So that's part of that fiscal 12 and 13 balance. $139 million is a darn good investment, or darn good return on our investment on that procurement accounting system. So a shameless plug for one piece of good news.
How much was the accounting system?
Around 65, I believe. So 2 to 1 for layman's terms.
Was that you or Commissioner Hanson who came up with that idea?
Thanks to Tom Hansen. All right. I think with that, we'll wrap up this briefing. Thank you very much.